Hey everyone, welcome back to Corporate Decoder, the place where we'll decode what's really going on behind the fancy financial jargon with a smirky, foreshadowing joke about stock splits and things changing. Today we're diving into Azitra Inc.'s latest report, a document that could tell us a lot about where this company is headed and whether its stock is about to get a whole lot smaller or at least a lot more expensive per share. Before we get into the nitty-gritty, stick around because we'll uncover the real story behind their recent corporate moves. And if you enjoy getting these straightforward breakdowns, be sure to hit that subscribe button. We also have a Discord community linked in the description below, where we discuss these reports and more. So we're looking at Azitra Inc., a company that deals with something called common stock. Think of common stock as tiny pieces of ownership in a company. When a company does well, these pieces can become more valuable, and when it doesn't, they can lose value. This report is basically an update to let everyone know about important events happening with Azitra. It's like a company's diary, but a very official one. Azitra's stock is traded on the ANZ American Exchange. This means it's available for regular people like you and me to buy and sell. The par value is just a small technical amount and doesn't really tell us much about the stock's real worth. Now this is interesting. Azitra is considered an emerging growth company. That means it's a relatively young company that's still growing and doesn't have to follow all the same strict rules as older, bigger companies, which can be a good thing, meaning they can be more agile but also a riskier bet. The main event here is a change to the company's foundational documents. Companies have these things called articles of incorporation. They're like the company's birth certificate. Azitra is changing theirs. So what's the big change? Azitra is doing a reverse stock split. Imagine you have 666 marbles and you decide to combine them into 100 bigger marbles. That's essentially what a reverse stock split does. They're taking all the existing shares of their stock and consolidating them. Specifically, it's a 1-for-6.66 split. This means for every 6.66 split. This means for every 6.666 split. This means for every 6.666 split. This means for every 6.666 split. This means for every 6.66 split. This means for every 6.66 split. This change becomes official very soon on August 21st. After that date, your shares will be fewer, but each share will represent a larger chunk of the company. So if you owned 666 shares, you'd end up with 100 shares. The total value of your investment might stay the same initially, but the price per share will go up proportionally. For example, if your stock was $1 per share before the split, it might become $6.66 per share after. Now what happens if you don't have a full 6.66 shares? Say you have 5 shares. You won't end up with a fraction of a share. Instead, the company will pay you cash for that fractional part based on the average stock price around the time of the split. This is standard practice to avoid the hassle of dealing with tiny pieces of ownership. All the official details about this change are in an exhibit called Exhibit 3.1. This is basically the legal paperwork for this corporate maneuver. This section is important. It's a disclaimer that tells us about statements that are about the future, like will and expected. The company is saying that these future predictions might not actually happen because there are many risks and uncertainties involved in running a business. They're legally protecting themselves by saying these are just expectations, not guarantees. They're specifically warning us that while they expect certain things to happen with this stock split and its impact on their stock, those outcomes aren't guaranteed. Things in the business world can change quickly and unpredictably, and they also say they don't have to update you if their future expectations change unless the law forces them to. So it's up to us to keep watching and interpreting what's going on. This is where they list all the attached documents that support the report. Here it is Exhibit 3.1, the certificate of amendment that officially started this whole reverse stock split process. And this last exhibit is basically a digital file that makes all this information easier for computers to read and analyze. This is the official sign-off from the company's leadership to confirm that everything reported is accurate to the best of their knowledge. Here we see the signature of Francisco de Salva, the Chief Executive Officer of Azitra Inc. His signature means he's authorizing this report on behalf of the company. So why do companies do reverse stock splits? Typically, it's to increase the stock price. A higher stock price can make a company appear more stable and attractive to investors, especially institutional investors like big mutual funds who might have rules against buying very low price stocks. It can also make the stock less susceptible to small price fluctuations, making it seem more polished. However, it doesn't fundamentally change the company's value or its business operations. It's more of a cosmetic change to the stock's appearance. The challenge for Azitra now is to ensure that this higher per share price is supported by real business growth and positive future prospects so the stock doesn't just stagnate or fall again. Now for our analysis based on what we see here. Azitra is taking a step to make its stock price appear more substantial. This is often done when a company's stock price has fallen very low, perhaps due to poor performance or market sentiment. Without seeing their financial statements in this particular filing, which they usually accompany a 10K or a more detailed quarterly report, it's hard to say definitively why they are doing this, but often it's a signal that the company might be struggling to maintain a healthy stock price or wants to avoid being delisted from an exchange due to low share prices. The risk here is that a reverse stock split alone doesn't fix underlying business problems. If Azitra's actual financial performance doesn't improve, the stock price could continue to decline even after the split, making the move seem like a desperate attempt to mask deeper issues. On the flip side, if this split is part of a broader strategy to signal stability as they grow, and if their business is truly on an upward trajectory, this could be a sensible step. The context external to this finding is crucial. We need to look at their recent financial performance, their market position, and their company's future plans to truly judge this move. Are they launching new products, signing major deals, or are they facing increased competition or declining revenues? Without that broader picture, this reverse split is just a single piece of data. In conclusion, Azitra is making a technical adjustment to its stock. The effectiveness of this will entirely depend on the company's actual business performance and its ability to deliver value to shareholders going forward. It's a move that signals a desire for a more respectable stock price, but it's not a guarantee of future success. What do you think about this reverse stock split? Does it make Azitra a more attractive investment, or is it a sign of worry? Leave your opinions in the comments below. Make sure to like this video if you found it helpful and subscribe for more corporate insights. Also, don't forget to join our Discord community for more discussions. Thanks for watching. See you next time.